Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. It's oil and energy expert Robert Rapier, newsletter writer. He's worked in the energy industry for a long time, and I'm happy to have him back on for his insights. So thank you for coming back on for a podcast, Robert.
Thanks for having me on again, Jason.
Great. Now, Robert, what's been happening in Iraq? Chris Martinson just put out an interesting video update about 5 minutes long for our listeners who want to go check that out. But he was talking about how there could potentially be refinery shutdowns, pipeline shutdowns. There's terrorists now that are starting to fight the U.S. military that are and the existing government that are in Iraq. Have they taken over a refinery yet, or have they blown up a pipeline yet in Iraq? And what type of damage could that do to the global oil price?
Yeah, so the Iraq situation, there is a story out this morning. Militants attack oil refinery and abduct 100 foreign workers. To put Iraq in perspective, Iraq is about 3.7% of the global oil production. Their oil production has gone up for 7 years in a row, and they've been one of the bright spots in the oil markets around the world. So, normally you'd think 3.7%, that's not that big a deal, but the oil markets are so tight right now, supply is barely able to keep up with demand, that taking that supply offline could have a really disproportionate impact on oil prices. And ever since the news started coming out of Iraq about the situation there, oil prices, both Brent and WTI, have traded up. Now, Brent has traded up more. Brent is a globally traded crude. It's more indicative of the waterborne crudes, like an Iraqi crude that's traded on the global markets. And so you see it trading up more than WTI, but WTI will follow it up. It'll just lag it behind a little bit. So it's more the risk, the worry of what's going to happen there than what has actually happened. I don't think much oil production has, or if any, has actually been impacted yet, although there is a story out today that BP and Exxon are evacuating workers. Says Seeking Alpha had an article this morning. Said ExxonMobil has carried out a major evacuation of its staff, and BP evacuated 20% of its staff. So this will ultimately impact oil production unless the situation gets reeled in pretty quickly, which it doesn't look like it's going to.
That's very interesting. And oil is the master resource, so we wouldn't have the modern society we have without oil. It's allowed for easy moving of storage and transportation costs. It's drastically made us infinitely more efficient. David Morgan, who's one of my friends, he was an engineer, and he was talking about the amount of human labor stored in a barrel of oil. And we just have so many, governments wanting to fight over oil. We have the stuff in China and Japan in the Senkaku Islands, I think. They're fighting. They don't even know if the oil and the gas is there per se, right? And they're just fighting over it. So it doesn't surprise me when one political party in another country, especially Iraq, because Iraq's a top 5 oil producer still, right?
Yeah, they're up there. I haven't ranked them. In fact, I'm about to. So where Iraq is at, I can't say at the moment, but you're in the ballpark. They're in the 4, 5, 6 neighborhood.
Okay. And let's transition here, because you wanted to talk about the BP Statistical review, but Iraq, like you said, is one of the few countries out there, probably obviously besides the U.S. and the shale boom that the U.S. has experienced. How is the global supply picture looking? Are other countries actually able to increase their oil production?
Yeah, so it's interesting. So the BP Statistical Review, it came out this week, and for those that don't know, it's a major overview of energy production and energy consumption for oil, coal, natural gas, renewables, nuclear. It is the Bible of oil consumption and production, or energy consumption and production statistics. And so when it comes out, it's like Christmas for energy wonks. And I've been pouring through the report. Something I noticed interesting. This has gotten no media attention as far as I can see. The U.S. oil production increased by 1.1 million barrels a day between 2012 and 2013. The world increased by a little over 500,000 barrels. That's the world including the U.S. So if you take the U.S. out of the picture, the rest of the world declined by 500,000 barrels. So, and the U.S. production increase is being enabled by the fracking boom. That's what's driving oil production. And some of that is natural gas liquids. It's not all oil, but there has been a real increase in oil production in the U.S. But now imagine the U.S. production had declined for 30 years before the fracking boom turned production around. Imagine that U.S. oil production is still in decline, and the rest of the world's in decline. We're talking about oil prices then. I don't know how high they'd be. They'd probably be above $150. They may be, with speculation and fear. There's no telling how high they could have gone. So, you talk about oil and what it does for us. We don't think about it to get really high, and we start thinking about scarcity. But without the fracking boom right now, oil prices, there's no telling where they would be. And I know a lot of people think this boom is going to run out. Then we are going to be looking at very high oil prices. I was thinking yesterday that the peak oil folks, they didn't miss it by that much. I mean, they missed the fracking boom, and they missed the turnaround in U.S. oil production. But you take that out of the picture, we are talking about oil production globally in decline and a much higher oil price being needed to support some of the marginal production. I mean, oil production around the world could go higher. I mean, if oil prices were $200, there's a lot of marginal production out there that could come online, but it's going to require higher oil prices for that to happen.
Those are very good points. And one thing I would add is that if we had a free market, Robert, so if we didn't have as many national oil companies that were taking a lot of the oil profits and spending money on social programs, so in Russia, in Saudi Arabia, in some of these other OPEC countries like Venezuela, they're not reinvesting the profits from their oil production, right? They're not investing any of the profits basically into finding more oil. Well, maybe in Saudi Arabia they are, but in a lot of these other countries they're not. So they're not upgrading their refineries. They're not spending the money on exploration budgets that they should. And that's why we're seeing this problem here, because in a free market, if these were private sector companies, they wouldn't want their assets to deplete that rapidly, right? They would go out and find the capital or do the JV deals or go farm out exploration budget to a junior oil wildcatter or someone like that to go and find them more oil. But we're not really seeing that from the national oil companies, and that's who controls the majority of the world's oil reserves at this point.
That's correct. I mean, Venezuela is a perfect example of that. The oil industry is extremely capital intensive. So when people point to billions and billions of profits, what they don't recognize, it takes billions and billions of capital expenditures to support those profits. And so you get a situation like Venezuela where, due to many, many years and many billions of dollars of investments, the profits start to flow, and then they divert those profits into social programs instead of I could justify, some spending of profits in support of these social programs. But if you divert too much, you don't support the infrastructure build out that you need to go ahead and expand your production. So Venezuela, sitting on the largest unconventional oil resource in the world, is seeing their production decline year after year after year. And it's simply because of the policies that are not allowing them to invest enough back in the business to grow that oil production.
It's a great point. And one thing about Venezuela, I think they're diverting almost all of their oil profits into social programs now. So I'm worried that one of their refineries could potentially, blow up. Their pipelines are decrepit. They're not putting any effort really into keeping oil production even flat, let alone grow. So I think they're going to have a lot of problems here going forward. And then you look at Saudi Arabia and Russia. The Saudis are reinvesting profits back into their oil exploration. They're doing fracking. They're going deep water. They're going offshore. But what you're also seeing, though, is that they've committed so much money to social program budgets, especially in Saudi Arabia, where a lot of the citizenry is not really happy with the government, the monarchy that's in place. And you see a scenario where they can't really have oil below, $80 a barrel, because then the governments will go bankrupt because they have to keep, giving their citizens more and more money with the social program commitments every single year.
Right. To balance their budgets, if you look what happened over the years, $20 oil, people are happy, and then oil gets to $50, and then they figure out ways to spend that money. And that's the way governments are. They bring in more money. They're looking around at ways to spend that money. And so every year, the break-even budget for these oil exporting countries goes up. And, Saudi gets to the point where they need $100 oil. Well, they have the pricing power to make that happen. I mean, they've got enough influence within OPEC. to make that happen. So, people who talk about oil prices falling to $50 and staying there, they're missing a couple of points. Marginal production, so much of the marginal production is so far above $50. I mean, most of the fracking oil, most of the shale oil requires a price higher than $50. So again, you go back to the U.S. and you take that 1.1 million barrel increase in the U.S. out of the picture, you've got oil prices that are skyrocketing because production is falling. And so, back to Venezuela, I just checked. Their production is down 20% in the last 5 years. That's amazing given the oil resource that they're sitting on, but it just goes to show you have got to invest in that infrastructure. And so I've used Venezuela as an example of, killing the goose that laid the golden eggs. They invested and they expropriated all these companies' assets, like ConocoPhillips, who I used to work for. We invested billions in the ground, and when they started to pay off, Venezuela went in and said, "That's nice, we will take that." And it's not like the oil company can say, "Okay, well, we'll take our assets out of the country." Those assets are in the ground. And so Venezuela has done that. They have soured partners. Nobody wants to do business with them except maybe China. But the result is their oil production is in decline as a result of mismanagement.
Yeah, and if we had a free market in the private sector were operating those oil fields, Robert, I don't think we would have this problem. I think Venezuela would have a lot of new capital equipment. They would have the upgrades necessary. They would have the CapEx budget and things like this. But the national oil companies, they have a completely different agenda than an ExxonMobil or one of these amazing mid-tier producers in the shale energy boom that took calculated risks and did a great job, where the majors didn't see the shale oil boom, and the majors completely missed out on that.
Yeah, these national oil companies are not always putting the most competent people into the right positions. And, a lot of times you've got political people in positions that should be, technical or production-oriented people. And that ultimately, when Venezuela, when they nationalized, they went in and they got rid of a bunch of competence. And it just shows in the oil production there how it's declined over the years.
Now, I want to talk again about the CapEx. So there's a couple different studies out about these enormous CapEx projections. We have a Barclays study out in the last 12 months. Barclays said that CapEx right now is over $620 billion with a B per year just to keep global oil production flat. Then we have the IEA, International Energy Agency, release a new report called the World Energy Investment Outlook recently, and they are projecting that total global CapEx for all different types of energy will need to be over $1 trillion a year just to keep world energy production flat. We have a Bernstein study in the last 2 or 3 years when we wrote an oil report. They were saying that CapEx is going up 9 or 10% per year. Are these trends going to hold in place, or do you think we're going to come out with new technology that's going to drastically be able to lower CapEx going forward?
Yeah, I don't see CapEx being dramatically lowered going forward. I see oil prices going up and supporting maybe higher CapEx. If I recall, the IEA report, $1.6 trillion a year through, I think it was 2035. And we're spending $1.2 trillion. We're spending a lot on infrastructure, but it's not enough. And so what that's going to mean is, in time, we're not going to be producing enough oil and enough natural gas for world energy demand, and the price is going to go up. But that also argues that you should be looking at these infrastructure builders as very ripe for investment. And, these guys are going to make a lot of money building out the oil infrastructure and oil and natural gas infrastructure.
Yeah, I agree. And to add a little color with some data points, the IEA is saying it will require $48 trillion with a T in investments through 2035. And that, like you said, might end up being low. But yeah, I definitely agree with your assessment of the infrastructure. I think there's also a lot of good investment opportunity for the drillers, the oil service companies who are maybe going to be allowed to go into Mexico. And Mexico has a lot of shale formations there with the Eagle Ford, right? And they're going to potentially be able to earn a lot of money in service contracts. And some of these rig operators and drillers and shale service companies in the oil patch, they have order books that are 10 years or longer, right? And they get to increase the price a little bit each year. That's pricing power, and someone's going to get rich off that CapEx, right?
Yeah, I mean, you mentioned Mexico, and it's kind of a sad story. Mexico does have a lot of shale. The Eagle Ford runs down into Mexico. They deal with some very unique problems down there. And there was a story the other day about drug gangs going through the street on tanks, and so they're having to dodge bullets down there to try to develop that oil. So a bit of a unique situation down there, not quite as industry friendly as South Texas.
So it's a very good point. But maybe the Mexican military will start protecting those like they do with some of the mines. Although with some of the gold and silver mines, I think the miners have to hire private security firms. But I know the Mexican government is very pro-mining down there now, although they recently increased the tax a little bit on the gold and silver miners, but they have been pro-mining for the last decade or two, and that's really increased the investment down there. It looks like they're going to need to do that with Pemex, too, because Pemex, so much of their oil budget went to social programs and into the politicians' pockets for whatever additional thing that Pemex has been starved of capital to, prevent those depletion rates on the Cantarell field. We're starting to see that where the depletion rates, I think, not only on Cantarell, on the North Sea and other major fields, the decline rates are starting to increase more rapidly than people thought.
Right. I mean, Mexico did decline again last year. They've declined for it's like 6 or 7 years in a row. It looks like they've been down year after year. And Mexico has recognized this, and they've recognized that they need some private industry partners. And last year they passed the law to bring people in, but a lot of companies are skeptical, and they're taking a kind of wait and see attitude. But yeah, you're right. A lot of these major oil producers are in decline. They're in trouble, and they're not going to turn around easily here unless they see some major reforms. Norway is another. Norwegian production. Norway was always a major oil producer. Their production was down over 4% last year, and is well down from their peak of a few years ago. Just looking across, there's not that many. There's the U.S. and there's everyone else. The U.S. increased production 1.1 million barrels a day. The next highest was 200-something thousand barrels a day. So that shows the U.S. is driving global oil production right now. Without the U.S., the world oil price just would be phenomenally high.
Yeah, I agree, and a higher oil price, puts inflation in the global supply chain. It crashes the economy. When oil spiked in, 2007? When oil spiked to $149 a barrel, that $5 a gallon price point for many U.S. consumers, it was too much. It basically crashed the economy. And Jim Poplava has a very interesting theory about the petro business cycle, where if the oil price spikes too quickly, it will crash the real economy. And this is all, these pretty high oil prices, a firm oil price, this is all despite the global economy really slowing down a lot. You have China basically slowing down, although their oil consumption is still increasing, but their real economy is not really growing, and they've built a lot of buildings that are not really being used, that are empty.
Yeah, and that's a good point. One other thing that was overlooked a little bit, I think, in the release of the BP Statistical Review, is U.S. oil consumption bounced back somewhat last year and was actually higher than the increase in consumption was higher than China's, so which was interesting. So
really?
Consumption in China did go up again, but U.S. consumption went up more than China's did.
Yeah, and I think that's a permanent trend that we're going to see with the developing world is the Chinas, the Indias, the Brazils, the Saudi Arabias, Africa, South America, those main continents, and Asia. That's where all the growth is coming from. I think BP said that in their last statistical review last year. I don't think that trend is going to stop. I think that a lot of people there, if you're in India and you're in a village, you've bought maybe your first car, maybe you all chipped in a couple $100 each in your village so you can buy your first car and you're going to share it. Once you put that money into the car, you're not going to want to stop driving it because the oil price is going up a little. So I think we're seeing a new normal here where more people in the developing world want to drive for the first time, and once they buy their first car, they don't want to stop buying their first car.
Right.
I mean, consuming oil.
Right. I'm looking at the numbers here. U.S. oil consumption increased by 397,000 barrels a day last year. China's was just under that at 390,000. The world as a whole was 1.4 million barrels. It went up 1.4 million barrels. Most of that is in developing countries. But if you look, the U.S. and China are responsible for more than half of the world's demand growth.
So basically, then you've just said then that demand is rising faster than supply, right? Because you said the demand for
Yes,
oil last year is increasing faster than supply can.
that happened.
And
Yes,
yes, now we're not going to run out of oil, right? So peak oil, maybe peak oil needed to be amended, but I don't. I think the cheap oil, I think it's clear that the capex is not really going to go down.
right.
So this is something that the big oil companies are finding out the hard way now. We had Goldman Sachs release a study recently talking about the big oil companies are basically in trouble in terms that they're not replacing their reserves and their production declines fast enough in their oil, and that they have a difficult decision to make coming up. They either have to keep their exploration budgets high and increase them based on the capex numbers that we've talked about already in this interview, or they have to cut their dividend. So either they're going to keep paying their dividend and increase their stock price, and the executives are probably going to get good stock options and things like that, or they're going to have to increase their capex budget, and they might run into problems like with what Shell oil had in the Arctic, where I think they've sunk over $20 billion in capex into Arctic oil, and they've gotten almost no production.
Right. There's another alternative there, though, that higher oil prices enable them to get out of this. I mean, higher oil prices, are a great enabler, and it may allow them to increase their capital budgets, their exploration budgets, and increase their dividends if oil prices continue to go up.
I agree with that. If the oil price slowly goes up, that would be beneficial for the oil companies, because we wouldn't have that big spike where it would crash the economy again. And I think they could adapt better to a slow and steady, higher moving oil price rather than a rapidly moving one. And I think unfortunately, consumers, the new normal. Even with the shale boom, Robert, I'm still my gasoline prices that I'm paying at the pump. I live right outside Washington D.C. in Northern Virginia. My prices are still going up,
right?
Despite the shale boom and all the great things that I've heard on CNBC and all these other things, my gasoline price has not dropped.
Right. We're not disconnected from world oil markets. And, if the U.S. was in a vacuum and we didn't export any finished products, we didn't import any oil, well, that's still another problem. And we still do import oil. So, our imports are falling, but we still have to bring in oil from the world markets. So U.S. demand still impacts that global price. But if we were in a perfect vacuum, U.S. prices over the years would have been much, much higher because we don't produce enough to satisfy our own needs, but the price would be going down because that situation is changing. It's just that what it would have meant is, we would have been paying 2 or 3 times as much for gasoline over the years simply because we don't produce enough to supply our own needs. So, you see people who say, we should not allow any exports to happen. Well, if you cut off all the exports, but you also cut off all the imports, we've got quite a shortfall still.
And then our economy isn't as productive. We can't transport goods as quickly and efficiently. We can't do really value-added manufacturing here in the U.S., which basically the shale boom, Robert, I think personally, besides the QE and the money printing, it's prevented that in Silicon Valley and the QE and money printing, it's prevented the U.S. economy from collapsing.
Correct.
It's brought a lot of jobs in. It's drastically reduced the U.S.'s trade deficit the last couple of years. And it's also at the margin, it's bringing a lot of, besides shale oil jobs with people working, in the Bakken in North Dakota or in Texas, it's brought back a lot of those factory jobs where people like in small towns in small states with low taxes, with South Carolina, Tennessee, Texas, Kentucky, those types of towns, and they're getting the jobs that were in Europe, that were in Asia. Maybe they're having more robots at the factory, but I think the shale boom has played a very large part in that.
Yeah, there was a story the other day that I saw. I don't remember the source, but it said, the irony is, in the Obama administration, if you take out the shale boom, we're very much in recession. I mean, that has saved the economy. It's provided a tremendous number of jobs. And, so the lower oil prices that we are paying relative to the rest of the world, and we're paying less than Brent prices, so we're seeing somewhat lower prices than the rest of the world. We're seeing low gas prices and a lot of jobs, and that sector has been, a star among all the sectors. And it's ironic because the Obama administration is not exactly known as being friendly to the industry.
I agree, and I think the shale boom has happened in spite of that, and they're not allowing any shale drilling on private lands, right, on national park area, even though there's some shale there, right? So this has all been done with hard work, boots on the ground. If our listeners go read a book, they should go an oil book about the shale boom. There's a good one out called The Frackers from Greg Zuckerman I finished recently. They should definitely go read that one, and it talks about how a lot of guys were out there pounding the pavement, negotiating, lease deals and land deals to get the shale positions. And the government probably would have tried to stop that at one point. I mean, obviously they don't want drilling on government lands yet. I don't think they've approved that. But it's amazing that in spite of these high taxes and rules and regulations, you have these hardworking people in the oil and gas industry and entrepreneurs figuring out ways around that. Correct.
There's no better example than the Keystone XL pipeline and that delay and that foot dragging that it's gone on for 5 years now. That is a very symbolic situation. I've said over and over again, if we don't partner with Canada, they will go elsewhere with that oil. And in fact, there is a story out today that the Canadian government has now approved Enbridge's Northern Gateway pipeline. And a lot of people said that will never happen. And that's the final regulatory obstacle for that project that would take Alberta oil to the Pacific Ocean. And so that's a direct consequence of foot dragging by this administration and failure to recognize the way the global oil markets actually work. That oil is going to get to market one way or another, and what it would do in the U.S. is it would push Venezuelan crude out, and it would trade basically a friendlier supply to the north for Venezuelan crude. But people who oppose that pipeline, and Obama is trying to appease them by foot dragging, just believe they will keep that oil in the ground by blocking that pipeline.
That's a good point. And unfortunately, Robert, there's a lot of people on Obama's political base, a lot of hardcore environmentalists. They don't want any human beings consuming hydrocarbons at all. So that's what we're dealing with here, and they don't care if it's going to create a lot of jobs. There's a lot of Americans out there looking for full-time jobs that these pipelines would put into play, and they don't understand exactly the point that you just made, that, yes, they're shutting off the U.S. from maybe putting the pipeline in, but the pipeline's going to get built somewhere, and the oil is going to end up going probably to China, and it's going to get consumed anyways. So right. It's just these people, a lot of these environmentalists, they don't understand economics at all, or they don't care. They probably don't care. Some of them don't even like human beings that much. They care a lot more about animals than human beings, unfortunately.
Well, I understand their desire not to have hydrocarbons consumed, but the hypocrisy and the irony is they consume hydrocarbons. So they're flying to these protests. They're getting around the world on hydrocarbons, and they're imagining a world with no hydrocarbons. They have no idea what that world would look like. They have no idea. They just envision that, well, we'll run off renewables, and they really have no clue at all. I've said before, you want to protest hydrocarbons, just stop using them for a while, and you will see. I mean, if global oil production was in serious decline right now, you wouldn't hear a peep out of the environmentalists, because people would be wanting to tar and feather them. They would say, you have helped this. You've helped this decline by stopping investments, and maybe the decline wouldn't be as steep if we had been making the investments that we needed to be making. So, we have the luxury of protesting oil because we've got it. But, if it was in decline and prices were $200 and headed higher, I don't think environmentalists would get any traction at all with people.
So that's a very good point. And now, in the remaining part of the interview, I want to talk about the shale boom. So we've had just continued production growth out of the Bakken and out of definitely out of the Bakken. I don't remember the Eagle Ford, but I don't remember the exact numbers for the other plays. But we're starting to see some new plays come online with the Permian, I think. Do you think we're going to be able to keep growing the oil production at the projections? And do you think that the Monterey Shale the reserves dropping. Do you think that's as big a deal as some other oil experts like Chris Martenson are making it to be, or do you think that's not a big deal?
I think it's not a big deal at all. And overlooked in that is that some of the people all along who've said the Monterey estimate is way overstated were the oil companies. I mean, Chevron was saying, we don't believe there's really oil there that we can get out at this price. And, they're headquartered there in California. They've got a major presence there. So some of the stories that have come out and said, well, the oil companies sold us a bill of goods and saying that there were billions and billions of barrels in the Monterey. I mean, yes, some of them may have overstated it, but there were also some that said, credibly, look, we just don't see it. And so, the oil is still there. There is still oil resource there. It's just that the geology there is complicated. It's been, that formations have been fractured by geology, and they're not smooth like a pancake. Like in the Bakken, if you take a oil well down and you turn it horizontally, you can travel along for 2 miles along that formation. And the Monterey is not like that at all. You can't turn that drill horizontally because it won't stay in the formation, because the formation is fractured and up and down and curvy. So it's just that the geology there is a lot more complicated. When they first made the estimates, they thought it would be more like the Bakken, but it wasn't. But the thing is, those were never considered reserves. It was always a resource. The difference is a reserve is oil that is technically and economically producible at current prices. So there was no write down of reserves. What they did, they came back and said, well, we thought there was this much oil there. It turns out there's only this much oil there. Nobody ever booked that. No company lost anything. In fact, one of the companies that was identified as going to be in trouble over this was Occidental, and their share price just rose after that report came out. I'm just checking to see what it is now, because it was up like 5% in the week following the release of that report. And it's up 7% over the last month. So that just goes to show, what the markets thought of, the Oxy. Their future wasn't dependent on the Monterey having that much oil. So it's just a matter. I mean, and the opposite holds true too. The Bakken, the reserves there have been doubled over the past few years. They've gone in. They said, there's a Three Forks underneath the Bakken, and we're starting to see production come in from that. And the way these reserves are honed is they look at actual production. And so in the Monterey, they looked at actual production, and they said these guys, the oil companies themselves, are not reporting the production gains, and they're saying, this geology is more complicated. So it's the oil companies themselves that result in that downgrade in the resource. But in the Bakken and the Eagle Ford, they're bumping those reserves up because they're saying, man, these guys are getting more than we thought. And that's not being reported. And so I don't think you can objectively report if you're focused on the Monterey downgrade, not saying, but at the same time, the Bakken, the reserve there has been doubled. It was doubled last year as they got more information in on what oil production actually was. So no, I don't think it's that big of a deal. The oil production in the U.S., you hit on the Eagle Ford, the Bakken. A lot of people don't realize that oil production in Texas is actually up a lot more than North Dakota. Oil production in Texas, I think, is up more than 2 million barrels a day in the last 5 years. In North Dakota, it's something like 700,000 or 800,000 barrels a day, but North Dakota is not historically a major oil producer. So North Dakota gets probably more of the headlines, but in Texas, you got two major formations in the Eagle Ford and the Permian Basin that 1920s, but fracking has opened up more of that formation. And so you see more and more oil coming out of the Permian Basin, coming out of the Eagle Ford, and, of course, the Bakken. And that has driven U.S. oil production up more than 3 million barrels a day in the last 5 years.
Now, I think the shale oil producers are going to be able to keep increasing production at least for another couple years in the future. I think the IEA is saying through at least 2020, but their projections are off a formula model. They're linear, right? But what worries me the most about the shale oil production, the shale oil producers, is that Bloomberg just did a study coming out, and these guys do not have clean, pristine balance sheets. They're not generating a humongous amount of free cash flow to pay dividends, to grow their production and reserves with free cash flow. They're growing with debt, Robert. And according to this Bloomberg study, their debt is growing 1.5 times faster than the revenue. So one of the things I've learned about the oil industry, and I'm sure you've heard this before, is you're not supposed to drill with debt. So this is right now, I guess it's working out because the oil price is pretty high. But if the oil price were to drop, I don't know how many of these guys are hedged, how much of their production is hedged, and they have a lot of debt service going forward. So yes, their earnings are good now, but in the future, since they borrowed so much, they're going to have a lot of debt to be paid back. And these oil wells, these shale wells, they start off at 2,000 or 3,500 barrels per day sometimes when they are initially fracked. And go into horizontal, and then they're fracked, and then they can decline very rapidly. So what worries me with the balance sheets of some of these shale oil producers is the debt.
Yeah, I mean, certainly, and that's the big question is if oil prices continue to go up and they can continue to expand, and how long they can continue to expand, some of these guys taking on debt are going to be just fine. If oil production turns down, if oil prices turn down and they're forced to curtail their production, yes, some of those guys will be in a lot of trouble. But some of them, that debt has paid off. They've been leveraged. You look at Whiting or Continental, those guys are generating some cash flow. You look at some of the newer guys coming in, they are definitely spending a lot more than they can expect to bring in for the next few years. But, I saw somebody point out that, it's like, if you put solar panels on your house, that's the case too. You're spending a lot more this year than you're going to see for several years. And it's just a matter of how much longer can production up there expand, and will the oil prices support it? It's a risk. Your highly leveraged oil companies would unravel very quickly, I think, if oil prices fell. But I've always had a hypothesis that for most of the majors, at least, as their production declines, oil prices are going to increase faster than their production declines. So I think they'll actually make more money as their oil production declines for that reason. And that has worked out so far. I mean, oil prices are 4 times what they were 10 years ago, but, production is down in some of these majors, just a fraction of that.
And that's a very great point. But another thing about that in the shale oil boom, and this ties in with the majors, why do you think the majors miss the shale oil boom so much? And do you think they're going to end up having to pay through the nose to buy out some of these pretty large shale oil producers like a Whiting Petroleum, like a EOG, like a Continental Resources?
Yeah, I mean, they didn't all miss it, but it wasn't big enough to move the needle for a lot of these companies. I mean, a lot of these companies have integrated global production, and they've got refineries, they've got chemical plants, so they, some of them are in there, and it just wasn't enough to move the needle, as opposed to, like an Oasis or something that's all they do is oil production in the Bakken, which, has helped drive their share price. ConocoPhillips is one. That's my former employer who spun off their refining assets, and they're very heavily focused on some of those sweet spots in the Eagle Ford, and they've done well. Shell, on the other hand, they didn't do so well. They came in late, and they didn't get good plays, and they had to write down some assets, some reserves. So some of those big guys are just not.
Yeah, Shell's been misallocating some capital. We talked about the Arctic misadventure where I think they wrote down, $20 billion worth of investments and got no production out of it.
Yeah, Shell has had some real missteps over the last decade.
Now, my final question here for this interview, and this pertains to the whole global energy market. Do you see any type of scenario out there, any type of panacea or magic bullet where the cost of energy is going to rapidly drop? We're seeing a lot of natural gas production increases here in the U.S. We're seeing an LNG market start to develop here in the U.S. over the next couple of years. Do you think that's going to drop the energy prices globally, or do you think energy prices globally, pretty much no matter what economic environment, are going to stay pretty firm?
Well, it's really partitioned. It's not just energy prices. There's oil, and then there's coal, natural gas, and the others. And some of those others are quite fungible. So coal is under attack from natural gas. So I think you'll see, and we have seen a sort of disparity between oil to natural gas price ratio over the last decade that has developed that is abnormal historically. And the reason is we've got lots of natural gas production that's helping to mitigate the price, but there is nothing mitigating oil prices. We don't have any replacement for oil. So you could say, you know, technically we could replace natural gas with nuclear power. We could replace natural gas with coal and vice versa. So those are all fungible. You can't replace 90 million barrels a day of oil with anything. I mean, there is nothing out there that could possibly replace that. So I tell people there's oil and there's everything else, and oil will remain under siege. The prices will remain under siege, and production will remain very, very important to maintain, you know, the price where it is. But I don't see it falling. It's just it's not under threat from anything. There is nothing like energy dense liquid that can replace very much of our oil production.
So that's a very good point, and I hear a lot of people that seem to know commodities, and none of them seems to be that bullish on oil, Robert. Well, the ones who know, you know, gold and silver and agriculture and things like this, when they look at oil, they say there's no catalyst to drive it higher, and then I just point at how the declines in all the old conventional wells, and then I say the capex required just to keep production flat, and I was like, someone's going to get rich off all this capex that's being spent. Maybe it's not, you know, the large oil producers, or those guys. Maybe it's someone in the service industry or the infrastructure boom that you were talking about, or some of these MLP companies redoing a pipeline to a new shale play, but someone's going to get rich off the capex.
Well, when somebody says there's no catalyst to drive it higher, I would say, how long have you been saying that? And what's the price? I mean, the price is higher. It's been, you know, $100 a barrel now is the new norm. And I see people try to slice it all sorts of different ways and say it shouldn't be over $50 or it shouldn't be over $80. You know, the fact is there's nothing. I mean, just like the BP Statistical Review showed, demand grew faster last year than production grew, and that is, you know, my peak light scenario that I came up with years ago was that production growth would lag consumption growth, and over time that would erode all of the spare capacity in the world. And what does that look like? It looks like peak oil. It looks like not enough supply to meet demand, and so prices have to respond to bring supply and demand back in balance. And I think that's what you're seeing. You're seeing the impact of most of the world's cushion of supply capacity is gone. We're producing as much as we can, and so any little hiccup, any threat of production upset is enough to drive prices much higher.
I agree, and I don't think the Saudi Arabia has the spare production capacity that they used to in the past, and even then their spare production capacity is with heavy sour crude oil, right, that needs more refining and needs a higher cost.
Yeah, they produced at near all-time records. Their production was down 1% last year, but it's still very near the top. So I would say that's correct. They don't have a lot of spare production capacity.
Well, we could. I love the energy markets, Robert. I think besides learning about how the banking system works and how the money works and inflation and things like that, I really like learning about the energy markets because they're so important to everything, to every other industry. I could talk about this for a long time with you, you know, about coal and LNG and natural gas and some of the other energy markets. But let's end the podcast here. Thank you again for your time, and please tell our listeners more where they can find your work.
Yeah, so I write a column in Energy Trends Insider. I usually write once a week there, just on the general energy markets. I write 2 investing-specific newsletters. One is, both of them are Investing Daily. One's called the Energy Letter. I write that once a week. It ties in the energy markets to the financial markets. The other is MLP Investing Insider. It's all about management partnerships. And I have a Investing Daily called the Energy Strategist, where we make specific buy-sell calls on the energy markets, and we run a model portfolio that, since I've been on board, has outperformed our sector by a pretty good margin.
Yes, it has. When I worked at Investing Daily, a lot of our marketing department was saying they wish that you managed their money.
Yeah, I had one of the managers there at the conference. We had the Investing Daily conference back a month ago. He said, whatever you say on energy, I do it. So, you know, we've made some good calls this year. We made ConocoPhillips and Devon, you know, American Rail Card. A lot of calls made a lot of money. And the most recent one we made was actually a solar company. We called it last week, and it's up 15% since Thursday. So we had a pretty good success.
Yes, I agree, and you're one of my favorite energy analysts, and we'll definitely have you back on again soon to recap the energy market. So thanks again for your time, and we'll have you back on again soon.
Thanks for having me on. It's always a pleasure.